to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host, and it is CPI day again. And why, oh why, does Christmas come but once a year? This is episode 46, and it is this month's CPI report. So let's set the stage for today's number. Going into today, the consensus was for about a 0.3% overall inflation rate and slightly above a 0.3% on core. That the swap market kind of saw 0.2% as headline, but 0.3 was sort of what the market was looking for. And part of the reason that that's lower than the core inflation numbers we've been seeing recently, we've been running, 0.5s and 0.6s for a while here with some 0.7s thrown in. One of the reasons that people became convinced that this number would be low is because of what happened last month with health insurance. And I talked about it in last month's CPI report, the way that the Bureau of Labor Statistics calculates the CPI for health insurance is kind of weird and wonky, and it basically has nothing to do with what you pay for health insurance. It's a plug number that accounts for the fact that consumers buy a lot of their medical care by paying for insurance, and then insurers pay doctors, but there's some leakage in there. And so if you ask doctors what they received and you ask consumers what they paid, they wouldn't add up. And so to make them add up, the BLS has to have this plug number in there, which they adjust once a year. And for whatever reason, they believe there's going to be a massive fall in medical care costs this year that needs to be spread out over 12 months. I'm a little skeptical. I suspect we'll end up adding that back. And I also think that medical care outside of that adjustment should probably lean the other way. But that hasn't happened so far. And going into today's number, economists, the ones who were surprised last month when it was too low, decided it was going to be low again. And so that was a large part of what people were expecting. But another important part was that has to do with rents. And home prices are flat to declining slightly nationwide. And rental, if you look at private rent surveys like Zillow Rents or what have you, you'll see that they are showing, decreases, especially in certain cities around the country, sharp decreases in rents being realized. And so economists said, well, gee, that's really timely data. And so the BLS rents data is delayed and smoothed. And so we shouldn't pay attention to that. We should pay attention to this really, really timely data. And the Fed wrote a paper about how, they need to take into, and the Fed speakers have been talking about how they need to take into account when we have this more timely data. We should take that into account and not get caught up in these long lags. Let's not make the lag of monetary policy any longer than it has to be. And the problem is that economists are kind of mistaking timely data for high quality data. There's a reason that private rent surveys are declining right now, and one of the reasons is that they were rising at 15 to 20%, a year ago. And we never saw that in the BLS in the CPI for rents. And so why you would think that we should now be seeing these decelerations, these drops, when we never saw the big acceleration is a little suspect, I think. But I'll get to that in a little bit. But that's one of the themes going in, and one of the reasons that people were thinking this would be a slower number. Look, we're past the peak in inflation, core inflation, headline inflation, and we're almost past the peak in median inflation, and we kind of all agree on that. Now, we've all agreed on that before, but in this case, it really kind of looks like that's probably correct. Where the real debate is going forward is that a lot of mainstream economica and the Federal Reserve believe that now that the peak is in, we're going to see inflation crash back down to 2%, 2.5% by the end of 2023. The basis of that view is that the inflation was really mostly about supply constraints, and now the supply constraints have been solved. There aren't such long lines at the Port of Los Angeles. Container costs have dropped a lot. Trucking costs have dropped a lot. Therefore, everything goes back to normal. Now, if you've been listening to any of these podcasts, you know that I think that's baloney. There were supply constraints, but the supply constraints were mainly caused by excess demand. And so they weren't, native supply chain problems. And they were all in the goods sector. And so, we'll get to this in just a second, but the question of what's happening to goods and goods inflation is a totally separate question from what is happening to services. And if in fact this was all a supply chain and everything's healing now, if that was the entire story, then we would have seen core goods skyrocket as they did, and then we'd see them crash back, and we wouldn't see really any major effect in core services. The fact that we saw lots of effect in core services tells you this is not a supply chain issue, and therefore healing the supply chains doesn't heal the inflation issue. It heals the goods part of it. But again, that's sort of, we all kind of knew that was happening, and the debate is over the rest of it. So the number prints, and it was only 0.1% on headline, 0.2% on core. So we had a 1/10 miss on core inflation. It was 1/10 lower month on month than was expected. And the headline number being about 1/10 lower was about the right spread. Economists had those numbers being about the same, and they were wrong. I mean, it was very easy to look at the gasoline and see that headline was going to be about 1/10 lower than core. I don't understand why economists can't do that math. It's pretty easy to go see. But anyway, so the core miss of 0.1% too low is about what we're talking about, 0.1 or 0.12, slightly too low. That was the lowest core figure month on month in well over a year. And at 0.2%, that would be, if we got 0.2% every month, then you get something like 2.4, 2.5% at the end of a year. And so we're back to normal, right? Before we had the COVID crisis, we regularly got 0.2, and occasionally you'd get a 0.1, and a real outlier, you'd get a 0.3. And that was kind of where we were. Well, now over the last year, we've seen 0.7, 0.6, 0.5, 0.4, 0.3, 0.2. So, there's a lot more volatility. That volatility is going to continue. We're probably not going to get some 0.7s for a while, but the volatility is going to be more than it has been in the past, and the overall level is going to be higher than it has been in the past. And today is sort of at the low end of the distribution that I think we're going to be seeing anytime real soon. If you look at the 8 major subgroups, which are food and beverages, housing, apparel, transportation, medical care, recreation, education, communication, and other. Of those 8 major groups, medical care declined, down 0.5% on the month. Transportation declined. Most of that was energy. Energy and used cars. And then every other category was up on the month, including apparel. Apparel had been a drag last month. Again, part of the core goods story. It actually advanced month on month today, which was a little surprising. I kind of thought we'd continue to see a drag in apparel, just like I thought we'd continue to see a drag in core goods, and we didn't this month. Within medical care, we had that drag from health insurance, but medicinal drugs, pharmaceuticals were up 0.1% month on month. Doctor services were up 0.04%. pretty weak, but positive. I kind of thought those would accelerate a little bit to offset some of the health insurance decline, but that hasn't happened yet. Median inflation, which hasn't printed as of now that I'm as of the recording of this podcast, I'm estimating it to be about 0.48%, which would be the lowest in about a year. We were a little bit lower, I guess, last December, but the last three figures have each been lower than the month prior. So there's some clear deceleration in the month-on-month from median CPI, and year on year has been, within rounding, 7%, 7%, and 7% for the last 3 months. So there's clearly some topping going on. We have one more sort of difficult comp or easy comp next month, but then we're probably going to start to see that year-on-year number come down. The interesting part is again, I kind of alluded to this, core goods prices decelerated, so that they only have risen 3.68% year on year over the last year. Remember, they had been up at like 13%, not that many months ago. But core services continues to accelerate 6.8%, 6.82%, and that had been down around 1.5 or 2 not so long ago, about a year and a half ago. So the core services actually continue to reaccelerate. Core goods plummeting, we sort of knew. It was a little bit more than we expected, but the fact that core services is accelerating still is, I think that's out of consensus. I think that most people have thought, both because of rents and because of services ex rents, I think most economists felt like those things were going to be decelerating. I think that rents are going to be decelerating. I think the other piece will eventually decelerate. I didn't think it was there yet, and I don't think it's going to be as severe as other people think. Primary rents year on year accelerated further. They have now risen 7.9% year on year, and owner's equivalent rent 7.1%. So both of those are new highs for those series. So again, the private surveys that are more timely are showing that both of these things are dropping rapidly. It's not showing up in the BLS data. And some of that is sort of a natural lag, and some of it's just better quality data. I don't think that those are necessarily wrong. They probably are lagged because you only take a portion of the sample and roll it over every month. But I don't believe if you talk to people, in some parts of the country, in cities, where most of the economists live, rents are declining, but they're not necessarily declining outside of cities everywhere in the country. And so I think that, again, all of the private rent indices tend to focus on where all the apartments are, but there are apartments everywhere. And so I think that the better quality BLS data, I think we can't really discount it. Yes, it's going to peak. Yes, it's going to come down. Both of those rent numbers are higher than my model had them going. So they're a bit over their skis. And so I would expect them to come down anyway. But I really don't think they're just going to collapse. And if they don't collapse, you're not going to get core inflation to collapse. And that's sort of the key point here, is that that's a big, slow, sticky category, is rents. And if you don't get that one right, then you're going to have a hard time getting core right. And if you want core to decelerate, you really have to see rents decelerate, and they're just not decelerating yet. Lodging away from home declined a little bit. And so let's go and look at some of the little small categories that tend to be a pain in the ass sometimes. Airfares fell 3% month on month. Used cars and trucks, which I thought would fall about 1%. Looking at the private surveys, they looked like they fell too much last month, and so I thought there'd be a give back. In fact, they're down 3% month on month. that's more than the private surveys say that they should be down. So I think that's going to end up being a give back. And new cars and trucks prices were unchanged to slightly higher. And again, that's part of the dynamic here. The used cars went way up, and they're kind of coming back a little bit. New cars, though, new car prices continue to rise. And again, if all of this was sort of a supply chain and we weren't producing because everyone was locked down, if it was that kind of story, we can't get chips, and all those things were true, you'd expect new car prices to be declining as well, and they're simply not. Let's see. So the core services X rents, 6.33% year on year, and that's down just a tiny little bit. I've spoken about this before in prior months. I've been focusing on this for several months. Ironically, suddenly everybody is looking at core services X rents and saying that's important. Well, it's important because that's where, as I've said before, that's where the wages show up. Services. If you look at things like other personal care services and some of the health services stuff, and there are a lot of obviously if there's services, you're paying wages, and that's the main input is labor. So when you have inflation go up and then you have wages follow that, it then moves into core services less rent of shelter, and that gives momentum to the overall process. Again, as with rents, so this is a lot less sticky than rents, but it's kind of the second less sticky of the four major groupings. If you don't have core services less rent of shelter decelerate substantially, again, you're not going to have core inflation go back to 2%. Okay, it's going to decelerate because core goods are decelerating, but it's going to be really hard to get it very low if you've got core services less rent of shelter at 6.3 and you've got rents at 7.9. It's hard to get in between those two things. That's more than half of the basket. It's sort of hard to get the overall number, and that's the majority of core. Hard to get the overall number down to 2, so that's just a simple math thing. Now, when you look at the distribution of prices, so one of the things I do is I look at all the lower level categories, and I calculate the year on year for each of these lower level categories and then put them on a distribution thing. And no, you don't get a nice bell curve. You never get a nice bell curve. There's always too much weight in one tail or the other, which is the reason I look at median rather than core. Core is an average, median is not. And so when you look at an average, those outliers really matter a lot. Two things sort of happen to that distribution this month, but over the last couple of months. And one of them is that those two tails they're tails on both sides. A lot of times you'll get, a big lower tail or a big upper tail because there's some weird outlier. In this case, there's lots of outliers on both sides. It's really diffuse, really diverse group of price changes. In the middle of the distribution, the mode kind of shifted from being just above 6% to just below 6%. And you can sort of see that when you look at the chart and you compare it to last month, you see this little shift to the middle. And a lot of that is some of the regional rent indices, but some other stuff that was growing around 6%. And so interestingly, if you look at the weight of components, the weight of the CPI that's inflating faster than 5%, it's about 70% of the basket. And that's been pretty consistent for the last 6 months or so. If you look at the weight of the components inflating faster than 6%, that was also pretty close to 70%, but has fallen off sharply over the last couple of months and is now only about a third of the basket, a little more than a third of the basket. So those really high, you still have some real high outliers, but the middle of the distribution is starting to shift left. And so that means that's one of the reasons that median is in the process of getting ready to start to come down a little bit. The biggest decliners on the month were used cars, car and truck rental, public transportation. There were a lot of big gainers, actually, even though the core overall was sort of weak. Those are the biggest decliners in core. The biggest gainers in core were miscellaneous personal goods, infants and toddlers apparel. There was actually a lot of apparel that kind of had some decent gains. Personal care services, vehicle maintenance and repair, communication, jewelry, watches, vehicle insurance, and one of the owner's equivalent rent regions for the South. And all of those inflated at an annualized monthly rate of more than 10%. Looking category by category, there's also an interesting story in the goods sector itself. If you look in recreation, you look at some of the goods in recreation, here are all of these things declined 1% or greater, month on month. TVs were down 3.8%, other video equipment down 4.1%, audio equipment down 1%, sports equipment down 1%, photographic equipment and supplies down 1.6%, toys down 1.8%. None of these are super huge weights, but do you see any commonality in those things? TVs, video equipment, audio equipment, sports equipment, toys. Those are all Christmas things. Those are all the sorts of things that people go to the mall to buy, or nowadays they go on Amazon or whatever. And ordinarily, those are all NSH and non-seasonally adjusted changes. So we expect those things to fall late in the year because they get discounted going into Christmas. The fact that they're that heavily discounting in November is a little unusual. And I think that, this is sort of reading between the lines. This is not the data. This is sort of anecdotal. But if you listen to retailers and you sort of read what retailers are saying, a lot of them are saying they have way too much inventory. They over-ordered, because last year was such a debacle. The last couple of years have been difficult, so they over-ordered. And you are seeing lots and lots of discounts. There were lots of pre-Black Friday sales, and I think that that's part of what showed up. If that's true, then the December markdowns that usually show up in CPI won't show up as much in CPI. So let me sum up here. Going into this figure, here's what I believed. 1, inflation is in the process of peaking. 2, goods price inflation is decelerating. 3, rents will eventually decelerate, but private surveys are overestimating that. 4, core services X rents, where the wage inflation is going to be sticky. And that 5, and most importantly, after the peak, and we all sort of agree there's a peak, where we disagree is how far core inflation is going to fall, core and median. It's not going to fall to 2. My belief going into this is it's going to go to 4 or 5%, right? And then it's going to get disagreeably stubborn, and it's going to be hard to push it a lot below 4%. Today's data, let's remember, the markets loved it. It means the Fed's going to go 50 basis points tomorrow. It means that they're probably going to do another 25, maybe another 25, but then they're probably going to stop. And that was kind of what we thought going in. That 1/10 is not going to change anything. It's just not a big enough miss to matter. And moreover, the misses were in core goods where we already it was in the same direction. It was just going down a little bit faster. So I don't think that any of this story really changed. And that means that, we're going into the end of the year with a number that is still quite high, is heading in the right direction, but it's going to take a few months before people realize it's not coming down as fast as they think it should be coming down. I think maybe it's going to take 3 or 6 months. And so I don't know exactly when markets will catch on and start to price that in, but it feels to me like kind of middle part of next year, we're going to see yield curves start to steepen. not because short rates are going to come down, but because longer interest rates are going to go back up. They've rallied quite a bit because the Fed is done and inflation is going to 2. And the Fed is probably close to done, but inflation ain't going to 2. And at some point, the curves are going to have to recognize that, and also recognize that you've got interest costs for the government going up quite substantially next year, along with Social Security payments. And so you're going to have deficits going up quite a bit and a lot more bonds to be sold. And you don't have the Fed sitting there buying them anymore. And so at some point, that's going to start competing interest rates higher, I think. But anyway, that's my view. That's today's number. I think even though it was only a 1/10 miss, where the miss happened, I think, is sort of an interesting story. And so that's all for today. You can contact me at inflationguy@enduringinvestments.com. You can follow the blog at inflationguy.blog. You can follow me on Twitter. At inflation_guy is the public Twitter. But if you want to get this sort of analysis on the CPI report in real time on CPI morning, if you're the kind of person that has some value to, then you should go to inflationguy.blog/shop, and you should subscribe to the private Twitter channel. Most importantly, even though inflation's coming down, that doesn't mean prices are coming down. Defend your money. And if inflation is coming for you, remember, you know a guy.